Ever felt like you need a secret decoder ring just to figure out the whole partnership and taxes thing?
Uh, yeah, I hear that a lot.
Good news is you've kind of found your shortcut. We're going to dive deep into this topic. It can feel like a maze, honestly, but there are some, well, genuinely surprising opportunities in there for smart tax management.
That's absolutely right. Today, our mission, if you will, is
Yeah.
to peel back the layers on partnerships and federal income tax. And our guide, it's going to be the insights packed into IRS Publication 541.
Right.
This deep dive is really designed to clarify how partnerships get taxed, help you make sense of those crucial forms, and maybe most importantly, pinpoint some key strategies, ways you can manage and maybe even optimize your tax situation as a partner.
Yeah, our goal here is to take all that dense tax jargon and turn it into something clear, something you can actually use. We want you to feel confident navigating these partnership tax rules and maybe, just maybe, have those aha moments that could actually save you some money. So let's unpack this thing.
Let's do it.
Okay, let's start right at the foundation. What exactly is a partnership, in the eyes of the IRS? And maybe the biggest concept here is what's often called the pass-through advantage.
Yes, definitely. So unlike a regular corporation, a partnership itself, generally speaking, doesn't pay federal income tax.
Okay.
Instead, all the financial stuff, profits, losses, deductions, credits, you name it, it all just flows or passes through directly to the individual partners.
Okay.
Then each partner reports their specific share of those items on their own personal tax return. This whole pass-through thing is really powerful because it helps you avoid that dreaded double taxation you often see with corporations.
Right, where the business pays tax and then shareholders pay again on dividends.
Exactly. So this structure can mean more cash ends up directly in the partner's pockets. It's a big strategic plus.
It sounds like a huge advantage, but how specific is the IRS definition? Like, is it just any two people deciding to do business together?
Not quite that simple. For federal tax purposes, an unincorporated organization, so not a corporation, with 2 or more members is typically classified as a partnership if they're carrying on a trade or a business or some financial operation, and they're dividing the profits.
Okay, dividing profits is key.
It is. It's important to distinguish that from, say, 2 people who just co-own a rental property and are merely sharing the expenses. If there isn't an active business operation or that division of profits, the IRS usually won't see it as a partnership.
And what about LLCs? Limited liability companies are super popular. Where do they fall in this?
Yeah, this is critical for so many business owners. A domestic LLC, one formed in the U.S., with at least 2 members, if it doesn't actively choose a different classification, like by filing Form 8032 to be treated as a corporation, then it's automatically, by default, classified as a partnership for federal income tax purposes. So if you're in a multi-member LLC, you absolutely need to understand these partnership tax rules. They apply to you.
Okay, this next point feels like something that could really change things for maybe spouses running a business together. It seems often overlooked, the qualified joint venture election.
Oh, this is a really smart move, potentially. For spouses who file a joint tax return and they co-own an unincorporated business together, they can actually choose not to be treated as a partnership for federal tax purposes.
Really? So what happens instead?
Instead of the business filing that partnership return, Form 1065, each spouse just accounts for their share of everything: income, gains, deductions, losses, credits, as if they were a sole proprietor. They'd report it all on their own Schedule C of Form 1040.
So the big immediate win is simpler paperwork, right? No complex Form 1065. Are there other benefits people might miss?
Absolutely. Beyond just simplifying the filing, a really significant advantage is that it allows each spouse to get individual credit for Social Security earnings based on their share of the net profit.
That's huge for retirement planning.
It really is.
Yeah.
It's crucial for building up retirement benefits separately, which can add up significantly over the years. Now, the eligibility rules are pretty strict. It's only for spouses filing jointly. Both have to materially participate in the business, meaning they're actively involved, and the business has to be co-owned directly by them, not held in the name of a state law entity like an LLC or LLP.
Okay, so if you're an LLC, even if it's just you and your spouse, this option is out.
Generally, yes, that's a key distinction. But if you do qualify, it's a fantastic way to streamline taxes and lock in those Social Security credits.
Knowing how the IRS sees your business structure is definitely half the battle. Okay, now let's get into the paperwork, the essential forms and filing requirements that partnerships need to know. The big one, the cornerstone, is Form 1065, right?
Form 1065, yes, that's the partnership's annual information return. Notice I said information return. The partnership itself isn't usually paying tax from it.
Right, pass through.
Exactly. So almost every partnership that's engaged in a trade or business or just has gross income has to file this form. It shows the partnership's total income, deductions, all that financial data. And critically, it details each partner's individual slice of those items. That's their distributive share.
So it's like the master document that tells the IRS what happened financially.
Precisely. Think of it as the blueprint. It shows the whole picture for the partnership before those specific details flow out to the individual partner's returns via Schedule K-1, which is generated from the 1065. Now, there are some rare exceptions, like if a partnership literally had zero income and zero expenses all year, it might not need to file. But that's uncommon for an active business.
And I know for businesses with global dealings, things have changed recently with reporting international transactions. More forms.
Yes, more specific forms. For international stuff, the IRS introduced Schedules K2 and K3 for Form 1065. These basically replaced some older, less detailed international reporting that used to be scattered on other schedules, like the K and K1.
Okay, what's the goal there?
The main goal is much greater clarity and transparency for the partners. These schedules are designed to give partners the specific information they need to accurately figure out their own U.S. income tax liability related to international items. Think of foreign income, deductions, credits for foreign taxes paid. It's about getting that global tax picture right.
Is the IRS pushing everyone towards electronic filing these days? Or is paper still common?
Well, most partnerships still have the option to file electronically, but certain larger partnerships, specifically those with more than 100 partners or partnerships that are required to file, say, at least 10 returns of any type during the year, they must file electronically.
Ah, okay. Mandatory for the bigger players.
Yeah, it's all part of the IRS's big push towards modernizing and speeding up tax processing. For everyone else, it's usually optional, but often encouraged.
What about when a partnership ends? What actually counts as a termination for tax purposes? And what happens then?
Good question, because it's not always intuitive. A partnership is considered terminated for tax purposes, basically, when all its operations are discontinued and no part of the business is carried on by any of its partners in a partnership format.
Okay, so complete cessation.
Pretty much. When that happens, the partnership's tax year ends immediately on the termination date, and they have to file a final short period Form 1065. The deadline for that is the 15th day of the third month after the termination date.
And here's a detail you mentioned that sounds important. What about converting a partnership to an LLC? Does that terminate it?
This is where people often get tripped up. If you convert a general partnership into an LLC, and that LLC continues to be classified as a partnership for federal tax purposes, which, remember, is the default for multi-member LLCs,
Right.
then generally that conversion does not terminate the original partnership. Its tax identity, its employer identification number, EIN, usually just continues seamlessly.
Wow, okay. That nuance about the LLC conversion not being a termination could save a lot of administrative hassle, maybe even prevent penalties if someone thought they needed to file a final return when they didn't.
Definitely. It's a key point for businesses undergoing that kind of restructuring.
Okay, let's switch gears a bit. Let's talk about money and property moving between the partnership and its partners. This is where basis calculations get really important, right? Starting with partnership distributions.
Absolutely. Distributions are fundamental. They can be simple cash withdrawals, maybe distributions of earnings the business doesn't need right now, or even involve liquidating a partner's entire interest. The core rule you need to grasp is that a distribution generally reduces a partner's adjusted basis in their partnership interest.
An adjusted basis is like my tax investment in the partnership.
Exactly. Think of it as your tax cost. It starts with what you initially put in, gets increased by your share of profits and additional contributions, and decreased by your share of losses, and, crucially, by distributions. But importantly, your basis can't go below zero.
Okay, so distributions lower my basis, but when do I actually have to pay tax, recognize gain or loss on a distribution?
Generally, you only recognize gain on a distribution if the amount of money you receive exceeds your adjusted basis right before the distribution. And note, for tax purposes, certain marketable securities are often treated just like money here.
Okay, so if I get property, not cash, generally no immediate gain.
Generally no immediate gain recognition just from receiving property. Any gain recognized is usually treated as capital gain. Now, recognizing a loss on a distribution is much rarer. It typically only happens if your entire interest in the partnership is completely liquidated, and the only things you receive in that liquidation are money, unrealized receivables, or inventory items. If you get any other type of property, like land or equipment, you usually won't recognize the loss then. Instead, it gets baked into the basis of the property you received.
Can you give us a quick example? Maybe walk through how basis adjusts with, say, Emily and Steve you mentioned earlier.
Sure. Let's say Emily has an adjusted basis of $30,000 in her partnership interest. She receives a distribution of $4,000 in cash, plus some property that had a basis of $20,000 on the partnership's books.
Okay.
Emily recognizes no gain because the $4,000 cash she got doesn't exceed her $30,000 basis. The property she receives takes a basis in her hands equal to the partnership's basis, so $20,000. Her remaining basis in the partnership interest is reduced by both the cash, $4K, and the property's basis, $20K, leaving her with a $6,000 basis in the partnership, $30K, $4K, $20K. Oh, wait, I think I misspoke in the original example outline for Emily. Let me restate that. Emily has $30K basis, receives $4K cash and $20K basis property. No gain. Her basis in the property is $20K. Her basis in the partnership drops to $6K, $30K, $40K, $20K. The example said $4 earlier. That was wrong. It's $6.
Okay, thanks for clarifying. So her partnership basis drops to $6,000. What about Steve?
All right, Steve. Let's say Steve has a $10,000 basis. He gets $4,000 cash and property with an $8,000 basis on the partnership's books. Now, his basis in the distributed property is limited. It can't be the full $8,000. It's limited to his basis in the partnership after accounting for the cash. So his $10,000 initial basis is reduced by the $4,000 cash, leaving $6,000. That $6,000 becomes his basis in the property he received. His basis in the partnership interest becomes zero.
So the property's basis got stepped down because he didn't have enough outside basis to cover it.
Precisely. Your basis in distributed property generally can't exceed your basis in the partnership interest right before the distribution, minus any cash received in the same transaction.
It sounds like it gets even more complicated if you receive, say, multiple different properties when your whole interest is liquidated. How does the basis get split up then?
It does get more specific, especially for distributions after August 5, 1997. There's a set order. You first allocate your remaining outside basis, after cash, to what the IRS calls unrealized receivables and inventory items. These are specific categories. Think accounts receivable for services or goods held for sale that often trigger ordinary income later. You allocate basis up to the partnership's adjusted basis in those specific items.
Okay, receivables and inventory first, then what?
Any basis you have left over after that gets allocated to any other properties distributed. Now, if you have more basis to allocate than the partnership's basis in those other properties, the increase generally goes first to properties that have unrealized appreciation. If you have less basis than needed, like Steve's case, the decrease is usually applied first to properties that have unrealized depreciation. It's a system designed to try and match the tax consequences to the underlying economics.
This definitely sounds like an area where keeping meticulous records of your basis is absolutely critical. Getting it wrong could really mess up your taxes down the line when you sell that property.
You nailed it. Basis tracking is paramount. And speaking of smart planning, there's a really valuable tool here. The special basis adjustment under Section 73210. This can be a significant opportunity, especially if you acquired your partnership interest through a sale, an exchange, or maybe inheritance from a deceased partner.
Okay, Section 73210, when does it apply?
It applies if you receive a distribution of property within 2 years of acquiring your interest, and the partnership itself didn't make a different kind of optional basis adjustment called a Section 75 and 54 election when you acquired your interest.
And how does this special adjustment actually help the partner? What's the benefit?
It essentially allows you, the partner, to adjust your basis in the distributed property to reflect the difference between your purchase price or inherited value for the partnership interest and your share of the partnership's basis and its assets at the time you acquired the interest. It's like letting you catch up on a basis adjustment the partnership didn't make.
Can you give an example, like that Chin Ho case?
Yeah, the Chin Ho example is good. He bought a 25% interest. Part of the value was tied up in inventory that had appreciated, but the partnership hadn't adjusted its basis. When Chin Ho received some of that inventory in a distribution within 2 years, he could elect under 732.2. This allowed him to increase his basis in that specific inventory by $500, reflecting the extra amount he effectively paid for his share of it when he bought his interest. This directly reduces his taxable gain when he eventually sells that inventory.
So it aligns his tax cost more closely with his economic cost. Is this adjustment always just an option, something you choose to do?
Mostly optional, but it's actually mandatory in certain situations. Generally becomes mandatory if, at the time you acquired your interest, the fair market value of all the partnership property was significantly higher than its adjusted basis, and if making the adjustment would cause a substantial shift in basis away from non-depreciable property towards depreciable property. It's an anti-abuse rule, really, to make sure basis gets allocated correctly.
Okay, mandatory in some cases. Good to know. Let's shift again, now looking at transactions directly between a partnership and its partners, like guaranteed payments. What are those exactly?
Guaranteed payments are payments a partnership makes to a partner for services rendered or for the use of capital, but, and this is the key part, they are determined without regard to the partnership's income. Think of it like a salary or a fixed interest payment.
So it's paid regardless of whether the partnership actually made a profit that year.
Exactly. From the partnership's perspective, for tax purposes, it generally treats these payments almost like they were made to an outsider. It usually deducts them as a business expense on Form 1065, typically on line 10.
And for the partner receiving it, how do they report it?
The partner reports guaranteed payments as ordinary income. They include it on their Schedule E of Form 1040, along with their regular distributive share of the partnership's other income or loss. It's taxed basically like wages, subject to income tax and self-employment tax.
Now, you mentioned a tax saving strategy here related to health insurance premiums for partners. This sounds like a great tip.
It really is,
Yeah.
and it's specifically for partners who provide services to the partnership. If the partnership pays health insurance premiums for a partner, those payments are typically treated as guaranteed payments.
Okay.
So the partnership gets to deduct those premiums as a business expense, reducing its overall taxable income, which benefits all partners. And then the partner who received the benefit, the one whose premiums were paid, generally gets to deduct 100% of those premiums as an adjustment to income on the front page of their Form 1040.
Wow, so a deduction for the partnership and a deduction for the partner. That's a definite win-win.
It's a fantastic benefit available to partners and LLC members treated as partners that isn't available to, say, S-Corp shareholders in quite the same way. It makes being a partner more advantageous from a health insurance perspective.
Can you quickly illustrate how guaranteed payments work with maybe Divya or Erica?
Sure, let's take Divya. She's guaranteed a minimum payment of $8,000. The partnership's income before considering her payment is $20,000. Her 30% share of that would only be $6,000. So the partnership pays her the extra $2,000 to meet the $8,000 guarantee. That $2,000 difference is the guaranteed payment. The partnership deducts it. Divya reports the full $8,000 as income, $6,000 distributive share plus $2,000 guaranteed payment.
Okay, makes sense. And Erica with the fixed payment.
Right. Erica gets a flat $10,000 annual payment no matter what. Let's say the partnership has $50,000 of ordinary income after deducting her $10,000 payment. She still reports the $10,000 as a guaranteed payment. Plus, she'd report her distributive share of the remaining $50,000 profit. If she's a 10% partner, that's another $5,000. So she includes $15,000 total in her income for the year.
Got it. Timing matters too, like with Lamont in the fiscal year example.
Yes, timing is crucial. If Lamont is a calendar year taxpayer, reports Jan 1 to the Cousin Letter 31, but he's in a partnership with a fiscal year ending January 34, 2024. Any guaranteed payments he received during the partnership's entire fiscal year, so from Feb 1, 2023 to Jan 31, 2024, are all included in his 2024 tax return. You report based on the partnership's year end that falls within your tax year.
Okay, that matching principle is important. What about sales between partners and the partnership? Especially if they're, related, like someone owns a big chunk of the partnership. Are there special rules?
Oh, yes. Very special rules kick in, primarily designed to prevent people from creating artificial tax losses or manipulating income character. The big one involves losses. If there's a sale or exchange of property, directly or indirectly, between a partnership and a person who owns, directly or indirectly, more than 50% of the capital or profits interest, or between two partnerships where the same persons own more than 50%, any loss on that sale is disallowed.
Disallowed completely, so you just can't take the loss.
You can't deduct it at the time of the sale, correct? It's a critical point for tax planning. You can't just sell a losing asset to your majority-owned partnership to recognize a quick tax loss.
Does that disallowed loss just disappear forever then? Seems harsh.
Not entirely, but the benefit is deferred. Here's the catch-up mechanism. If the person who bought the property, the related party purchaser, later sells that same property at a gain, they only have to recognize the gain to the extent it exceeds the amount of the loss that was previously disallowed to the seller.
Ah, okay. So the disallowed loss can shelter a future gain on the same property?
Exactly. It provides some eventual relief, but it delays the tax benefit. Now, on the flip side, if there's a gain on a sale between these related parties, more than 50% ownership, that gain is treated as ordinary income if the property being sold is not a capital asset in the hands of the buyer immediately after the transfer.
So, preventing the conversion of potential ordinary income into capital gain through related party sales.
Precisely. It stops maneuvers like selling depreciable property to your controlled partnership to get capital gains, while the partnership gets depreciation deductions against ordinary income.
Let's touch on contributing property. Normally, if I put property into a partnership for an interest, that's tax-free, right?
Generally, yes. That's a foundational rule of partnership tax, Section 721. No gain or loss is typically recognized by either the partner or the partnership when property is contributed in exchange for a partnership interest.
But I sense a but coming.
Well, there's always a but in taxes, isn't there? The IRS looks out for situations that look like a contribution but are really a sale in disguise. They call these disguised sales.
How does that work?
If a partner contributes property, and then shortly thereafter, there's a related distribution of cash or other property from the partnership to that same partner. And when you look at the whole transaction, it really functions like a sale. The IRS can recharacterize it. They'll treat it as if the partner sold the property to the partnership, or maybe sold part of it. This usually requires filing a special disclosure form, Form 8275, to let the IRS know about the potentially disguised sale nature of the transaction.
So, contributing property and immediately taking cash out might trigger this?
It's a red flag, definitely, especially if the amounts are linked. Now, another big complexity arises when the property contributed has a fair market value that's different from its adjusted basis, what we call built-in gain or loss.
Right, like contributing land that's worth way more than I paid for it. How does the partnership handle that?
This is governed by Section 704C, and it's fundamental. The partnership must allocate income deductions, gains, or losses related to that specific property among the partners in a way that takes into account that built-in gain or loss, meaning the partner who contributed the appreciated or depreciated property eventually has to recognize the pre-contribution gain or loss when the partnership either sells the property or sometimes through depreciation deductions over time.
Can you illustrate that, like the Arita and Sophia example?
Sure. Let's say Arita contributes cash, $10,000.
Yeah.
Sophia contributes depreciable property also worth $10,000, but her adjusted basis in it was only $4,000. So there's $6,000 of built-in gain. The partnership now takes Sophia's $4,000 basis for depreciation purposes. Let's say the depreciation is $400 per year. Even though Arita effectively bought half the asset for $5,000, the partnership's total depreciation deduction is limited to $400. Under the 704C rules, that entire $400 depreciation deduction must generally be allocated to Arita, the non-contributing partner, until she's effectively recovered her share of the basis. Sophia gets zero depreciation in this case.
Wow. So Sophia doesn't get any depreciation benefit, and the built-in gain she brought in is preserved to be taxed later.
Essentially, yes. It ensures tax fairness by making sure the tax consequences of the pre-contribution value difference stick with the contributing partner. It's complex, but crucial for equitable allocations.
This is definitely a deep dive. Okay, let's tackle some more advanced topics now. Section 161, reporting. This sounds technical. What's the deal with the applicable partnership interest, or API rule?
Right, Section 161. This is really important, especially for folks in investment management, private equity, venture capital, that sort of thing. The rule targets what's often called carried interest. An API is basically a partnership interest received in connection with performing substantial services in an applicable trade or business, typically involving raising capital and investing in assets like securities or real estate.
Okay, so it's about interests earned through services, not just capital contribution. What does the rule do?
Here's the kicker. Section 1061 can recharacterize certain long-term capital gains allocated to a partner holding an API as short-term capital gains if the holding period of the underlying asset that generated the gain is 3 years or less.
Wait, long-term becomes short-term? That sounds bad for the taxpayer.
Generally, yes. It's usually not a tax-saving rule. Short-term capital gains are taxed at ordinary income rates, which are typically much higher than long-term capital gains rates. So this rule can significantly increase your tax liability. It's designed to make it harder for service partners to get preferential long-term capital gains treatment on gains realized relatively quickly. Understanding this is vital to avoid nasty tax surprises.
How in the world do you report something like that? Are there special forms?
Yes, there's specific reporting involved, mainly through worksheets. The partnership, or other pass-through entity, is supposed to provide information to the partner holding the API on a specific attachment, often labeled Section 161 Worksheet A, which comes with their Schedule K1.
Okay, info comes from the partnership.
Then the individual taxpayer, the API holder, has to take that information and complete their own calculations, typically using Worksheet B and its related Tables 1 and 2 from the Form 1065K1 instructions. These worksheets calculate the recharacterization amount, which then gets reported on the partner's Schedule D in Form 8949, effectively turning some long-term gain into short-term gain.
That IRS example with taxpayer M sounds like it illustrates the bite $35,000 of long-term gain switched to short-term. Ouch.
Exactly.
Yeah.
It shows the potential impact. It requires careful tracking of holding periods and applying these specific rules.
Okay, let's shift to disposing of a partnership interest altogether. What happens if an interest is just abandoned or becomes totally worthless? Is there a tax planning angle there?
There absolutely can be, and it's a really important one, though the rules are tricky. A loss from abandoning a partnership interest, or because it becomes completely worthless, can potentially be claimed as an ordinary loss.
Ordinary loss. That's usually better than a capital loss, right?
Uh,
Because it can offset ordinary income.
Precisely. Ordinary losses are generally much more valuable than capital losses, which have limitations on how much you can deduct against other income each year. But, and this is a huge but, you can only get ordinary loss treatment if the abandonment or worthlessness is not treated as a sale or exchange, and if the partner receives no actual or deemed distribution from the partnership when the interest is abandoned.
Deemed distribution. What's that?
That usually means relief from partnership liabilities. If the partnership has debts, and by abandoning your interest, you're no longer considered responsible for your share of those debts, the IRS treats that relief of debt as if you received a cash distribution.
Ah, so even if no cash changes hands, being relieved of debt can mess up the ordinary loss treatment.
Exactly. Even a tiny amount of liability relief, a de minimis amount, can convert what might have been a valuable ordinary loss into a less favorable capital loss. This is critical. If you want that ordinary loss, you need to ensure there's absolutely zero distribution, actual or deemed.
Wow, that's a planning point where the details really matter. What about a straightforward sale or exchange of an interest?
Selling or exchanging your partnership interest usually results in capital gain or loss. It's treated like selling stock, generally. The gain or loss is the difference between the amount you realize and your adjusted basis in the interest.
And the amount realized isn't just the cash I get, right? You mentioned liabilities earlier.
Correct. This is a point people often miss. The amount realized includes not only cash and the fair market value of any property received, but also your share of any partnership liabilities that the buyer assumes or that you're relieved of as part of the sale.
Like in that Kumar example.
Yeah, Kumar sells his interest for $10,000 cash. His basis is $20,000. Looks like a loss, right? But wait, he's also relieved of his $15,000 share of partnership liabilities. So his total amount realized is $10,000 cash plus $15,000 liability relief, equaling $25,000. Compared to his $20,000 basis, he actually has a $5,000 capital gain, not a loss. Forgetting the liability relief is a common and potentially costly mistake.
Okay, so always factor in the debt relief. Is there a way to defer tax on the gain if you sell your interest? Maybe if you get paid over time?
Yes, potentially.
Hmm.
If you sell your partnership interest at a gain and receive payments over multiple years, you might be able to use the installment method to report the gain. This lets you defer paying tax, recognizing portions of the gain only as you receive the payments.
That sounds helpful for cash flow. Any catches?
The main catch is that any portion of the gain that's attributable to the partnership's hot assets, specifically unrealized receivables and inventory items, cannot be reported using the installment method. That part of the gain has to be reported as ordinary income in the year of the sale, regardless of when you get paid.
Ah, those pesky unrealized receivables and inventory items again. They seem to trigger ordinary income a lot. What if I receive those items in a distribution, not cash, and then sell them later? Is there a strategy there?
Yes, and this is potentially a very powerful tax planning opportunity. Generally, if you receive unrealized receivables or inventory items in a distribution from the partnership, and then you sell them, the gain or loss is taxed as ordinary income or loss. That's the default.
Okay, ordinary income. But you said opportunity.
Here it is. There's a special exception specifically for inventory items, not unrealized receivables. If you hold those distributed inventory items for more than 5 years after the date they were distributed to you,
More than 5 years. Okay.
then the character of the gain or loss on their subsequent sale can change. If the inventory item qualifies as a capital asset in your hands at the time you sell it, meaning you weren't holding it primarily for sale to customers in your own business, then the gain or loss becomes capital gain or loss, not ordinary.
Whoa. So just by holding on to distributed inventory for over 5 years, I could potentially convert what would have been ordinary income into potentially lower tax, long-term capital gain.
Exactly. That's the power of this rule. It requires patience holding for 5 years. But the tax savings can be substantial if you can shift income from ordinary rates to preferential capital gains rates.
That definitely feels like an aha moment. Can you illustrate that quickly with Mauricia?
Sure. Marussia gets inventory in a distribution. Let's say her basis in it is $19,000. If she sells it for $24,000 within 5 years, that $5,000 gain is ordinary income, taxed at her regular rate.
Right.
But if she holds that same inventory for, say, 5 years and a day, and at that point is considered a capital asset in her hands, maybe she's no longer in that line of business, when she sells it for $24,000, that $5,000 gain could potentially be taxed as long-term capital gain, likely at a much lower rate. Strategic timing makes a huge difference here.
That is a fantastic planning tip. Okay, so much detail. Let's wrap things up by looking at how audits work now because the rules changed and also where people can get help navigating all this complexity.
All right, the audit rules underwent a major overhaul with the Bipartisan Budget Act of 2015, the BBA. This replaced the old system, known as TEFRA, for partnership tax years starting after 2017. The BBA created a new centralized partnership audit regime.
Centralized. What does that mean in practice?
It means the IRS generally audits the partnership itself at the partnership level, rather than auditing each individual partner separately for partnership items. And under these rules, partnerships must designate a specific partnership representative.
Partnership representative, what power do they have?
They have the sole authority to act on behalf of the partnership during an IRS audit. They make decisions like whether to contest findings or agree to adjustments, and those decisions legally bind all the partners. It's a position with significant responsibility and power.
Wow, one person binding everyone. That sounds potentially risky for individual partners. Is there any way out of this centralized system? Another planning opportunity, perhaps?
Yes, there is. And it's an important annual election for smaller partnerships. Eligible partnerships can choose to elect out of the BBA centralized audit regime each year.
Who's eligible?
Generally, a partnership is eligible if it has 100 or fewer partners during the year, and all of those partners are themselves eligible partners. Eligible partners typically include individuals, C corporations, S corporations, and estates of deceased partners. Partnerships, trusts, and certain other entities are generally not eligible partners, meaning if partnership has even one partner that's another partnership, you usually can't elect out.
Okay, so if you have 100 or fewer eligible partners, you can elect out. What's the benefit of doing that?
The main benefit is avoiding that centralized process where one representative makes binding decisions and where potential tax liabilities might be assessed at the partnership level. If you elect out, any audit adjustments related to the partnership items are handled directly with each individual partner on their own return, like under the older system. It gives partners more individual control over the audit process concerning their share.
How do you make that election?
The partnership makes the election annually on its timely filed Form 1065, specifically on Schedule B2. It requires providing detailed information about each partner name, taxpayer ID number, federal tax classification. It's an annual choice, and once made for a year, it generally can't be revoked without IRS consent. So it requires careful thought each year.
That sounds like a really significant decision point for eligible partnerships. Okay, finally, with all this complexity we've discussed, people might feel overwhelmed. Where can listeners turn for reliable tax help directly from the IRS?
The IRS actually offers a ton of resources, many of them free. The absolute first stop should always be their website, irs.gov. It's packed with forms, publications like the Pub 541 we've been referencing, instructions, and FAQs. And it's available in multiple languages, too.
What about online tools or help with filing?
Yeah, they have lots of online tools. The tax withholding estimator is great for employees. There's an online EIN application for businesses. For actually preparing returns, if you meet income requirements, there are free options like IRS Free File, which links to commercial software, or Direct File in some states. There are also volunteer programs like VIA, Volunteer Income Tax Assistance, and TCE, Tax Counseling for the Elderly. And MilTax offers free help for military members.
So lots of free help options if you qualify. What about just accessing your own information or making payments?
You can set up an individual online account at irf.gov to see your payment history, view tax records, get transcripts, see notices, and for payments, they offer direct pay from your bank account, debit credit card options with a fee, EFTPS for businesses, and even ways to pay in cash or set up payment plans or an offer and compromise if you're facing hardship. Direct deposit for refunds is definitely the way to go too.
And if you run into serious problems with the IRS,
If you're having significant issues resolving a problem with the IRS, the Taxpayer Advocate Service, or TAS, is an independent organization within the IRS. Their whole job is to help taxpayers resolve problems and protect taxpayer rights. They can be a really valuable resource in difficult situations. Okay, that's a lot of ground we've covered. We've navigated the essential forms like 1065, K1, K2, K3, decoded some real.
so true. So, as you, our listener, think about your own business ventures, especially any partnerships you're involved in. Maybe ask yourself,
Yeah.
what overlooked details, what hidden opportunities from today's discussion might be waiting for your personal deep dive? Those IRS publications, yeah, they're dense, but they are truly packed with powerful insights if you know how to look and, more importantly, how to apply them.